January 2026. As you watch this, the financial system most people assume is permanent is quietly shifting beneath their feet. The United States has crossed a level of debt so large that the numbers no longer trigger urgency. Trillions accumulate daily, yet markets remain calm. That calm is misleading. The real signal is not how much debt exists, but how the rest of the world is responding to it. For decades, the dollar expanded alongside global trust. That relationship is changing, not through panic, not through collapse headlines, but through quiet adjustments. Nations are rewriting trade agreements, settling transactions differently, and reducing exposure without making noise. History shows this phase is always the most dangerous because it feels stable right up until it isn't. This moment is not about ideology or politics. It is about alignment. Rising deficits are colliding with declining confidence, and when those forces meet, systems begin to reorganize. Not suddenly, but decisively. Power does not disappear overnight. It fragments first. By the end of this breakdown, you will understand the repeating mechanism behind every reserve currency transition in history. More importantly, you will understand why recognizing the timing matters more than reacting to headlines later. This is not about fear. It is about seeing the shift before it becomes unavoidable for everyone else. Every reserve currency in history follows the same structural path, regardless of culture, technology, or era. The sequence unfolds in 4 stages, driven not by opinion, but by incentives. Stage 1 begins when a nation achieves overwhelming leverage. It may control military power, trade routes, energy supply, or critical resources. Other countries use its currency not because it is superior, but because participation in global trade requires it. There is no alternative. Stage 2 emerges quietly. The issuing nation recognizes it can spend beyond its production. Currency creation replaces discipline. Deficits grow, wars, social programs, and expansion are financed by issuing claims rather than earning value. Inflation is exported abroad as foreign nations hold the currency in reserve. Stage 3 begins when trust erodes. Trade partners notice their reserves lose purchasing power. Bilateral agreements appear. Alternative settlement systems gain traction. The dominant power often responds with pressure or sanctions, but confidence cannot be restored by force. Once doubt enters, exit strategies multiply. Stage 4 arrives quickly. Abandonment accelerates. Demand for the currency drops sharply. Inflation or severe devaluation follows at home. Economic contraction and social stress emerge. A new monetary order replaces the old one. This pattern has repeated for centuries without exception. Reserve currency status creates an illusion of safety that eventually undermines itself. When the world must hold your currency, restraint feels unnecessary. Production matters less than consumption. Borrowing replaces competitiveness. Over time, the issuing nation begins to live beyond its real economic output, importing goods while exporting currency instead. This arrangement appears stable because the consequences are delayed. Foreign holders absorb the depreciation quietly. The issuing country experiences growth without sacrifice. But every unit of currency sent abroad is a claim on future value. When those claims grow faster than real output, the imbalance compounds. Eventually, trade partners recognize the asymmetry. They work, manufacture, and export tangible goods while receiving currency that buys less each year. Alternatives do not need to be perfect. They only need to reduce dependence. Once that process begins, demand for the reserve currency weakens structurally. At this stage, confidence does not collapse all at once. It thins. Demand fragments. The system appears functional until a tipping point is reached. That is why reserve currency failures are rarely predicted accurately in real time. The danger is not sudden collapse. It is slow erosion followed by rapid adjustment. Monetary dominance does not fail because of enemies. It fails because incentives drift too far from reality. In the 16th century, Spain stood at the center of the global economy. Its dominance came from control of silver, the most critical monetary resource of the era. Vast mines in the Americas supplied unprecedented quantities of precious metal, flooding international trade routes. Spanish silver became the medium of exchange across Europe, Asia, Africa, and the New World. Trade did not require trust in Spain's governance. It required access to silver, and Spain controlled it. This advantage quickly altered incentives. Manufacturing declined as imports surged. Why produce locally when coins could be minted endlessly and exchanged for finished goods? Spain financed wars, expansion, and luxury through currency issuance rather than productivity. For decades, the system appeared to work, but the imbalance grew. Trading partners noticed declining silver quality and rising prices. Inflation spread. Confidence weakened. Merchants sought alternatives, settling trade outside Spanish control. Competing powers built parallel networks to bypass Spanish currency entirely. Spain responded with restrictions and force, but trust could not be compelled. Capital fled. Bankruptcies followed. Within a century, the empire that dominated global money lost its position completely. Silver lost credibility. Spain never recovered reserve status. The collapse did not occur because silver vanished. It occurred because confidence did. Britain's rise was built on naval dominance, industrial output, and gold-backed credibility. By the 19th century, global trade flowed through British shipping lanes, and the pound sterling became the primary settlement currency. Participation in international commerce required access to pounds, reinforcing Britain's financial authority. The first fracture emerged with large-scale war. World War I forced Britain to abandon monetary discipline. Gold convertibility was suspended. Currency issuance replaced savings. After the war, attempts to restore the old standard failed because the economy could not support prior commitments. World War II completed the shift. Debt surged, foreign confidence weakened. The United States accumulated gold, while Britain relied on borrowed capital. Although Britain attempted to preserve influence through trade zones and currency controls, partners steadily exited. Repeated devaluations followed. Currency crises became frequent. Eventually, reserve status was lost entirely. The pound did not disappear, but it became regional rather than global. Britain's decline illustrates a critical lesson. Reserve currencies do not collapse because empires lose power overnight. They collapse because fiscal reality overtakes monetary privilege. Once credibility erodes, recovery is impossible. The system moves forward without waiting for permission. When the dollar faced crisis in the 20th century, it did not collapse immediately. Instead, it adapted. After gold convertibility ended, a new structure emerged linking global energy trade to dollar settlement. Oil pricing created mandatory demand for U.S. currency, stabilizing the system despite growing deficits. This redesign postponed consequences rather than eliminating them. Persistent trade deficits expanded, debt accumulated, currency issuance accelerated. Foreign nations continued holding dollars because energy markets required it, not because fiscal discipline improved. Over time, the imbalance deepened. Monetary expansion outpaced productive growth. The system remained functional only because alternatives were limited. Once new settlement options emerged, the foundation weakened. The critical insight is this: reserve currency systems do not fail when confidence is high. They fail when necessity declines. As soon as essential trade can occur without a single currency, forced demand dissolves. The dollar's evolution extended its lifespan longer than any system before it, but adaptation is not immunity. It merely delays stage 4. What matters now is not how long the dollar dominated, but whether the conditions that supported it still exist. History shows that once necessity fades, transitions accelerate rapidly. Late-stage currency transitions are never loud at first. They do not begin with crashes or public announcements. They begin with small, deliberate adjustments that appear technical rather than dramatic. Trade agreements are rewritten. Settlement terms change. Central banks rebalance reserves. None of this feels urgent to the public, but it is decisive. At this stage, countries are not attempting to overthrow a system. They are reducing exposure to it. The difference matters. When risk becomes visible, rational actors hedge first and explain later. Monetary systems do not collapse from rebellion. They erode from diversification. The defining feature of Stage 3 is fragmentation. No single alternative replaces the old currency immediately. Instead, multiple options emerge. Energy trades settle in different units. Regional blocks rely on local arrangements. Gold accumulation accelerates quietly. Demand disperses rather than disappears. From the outside, everything appears stable. Markets function, payments clear, confidence seems intact. But underneath, structural demand weakens. Once the tipping point arrives, adjustments that took years to build occur in months. History shows this repeatedly. By the time the shift becomes obvious, positioning opportunities have already passed. The danger is not sudden collapse. The danger is believing stability today guarantees stability tomorrow. That assumption has never survived stage 3. Modern governments finance deficits by issuing debt. That debt requires buyers. For decades, foreign reserve holders absorbed large portions of issuance, recycling trade surpluses into government bonds. This arrangement allowed persistent deficits without immediate consequences. The problem arises when trade no longer generates surplus dollars abroad. If transactions settle in alternative currencies, reserves stop accumulating. Demand for new debt weakens. The financing burden shifts inward. At that point, central banks face a narrowing set of choices. Either interest rates rise to attract buyers, increasing debt service costs, or monetary authorities purchase the debt themselves. Both options carry consequences. Higher rates strain the economy. Monetary expansion fuels inflation. This is where confidence gives way to arithmetic. The system no longer depends on belief, it depends on cash flow. Rising interest payments consume growing portions of government revenue, limiting policy flexibility. Political solutions disappear. Every historical example resolves the same way. Authorities choose currency expansion because default is unacceptable. Inflation becomes the release valve. This is not a failure of leadership or intelligence. It is a structural endpoint. Once debt servicing grows faster than revenue, monetary discipline becomes impossible. The system enters a self-reinforcing loop. Confidence fades not because people panic, but because the numbers no longer balance. Every reserve currency era produces the same belief, that its system is uniquely protected. Superior institutions, advanced technology, stronger military power. Each generation finds reasons why historical patterns no longer apply. None have been correct. Spain believed silver guaranteed dominance. Britain believed industrial capacity ensured permanence. The United States believes innovation and technology will override monetary limits. But productivity cannot cancel arithmetic. Technology accelerates growth, but it cannot justify unlimited claims on finite output. History does not repeat because leaders make identical mistakes. It repeats because incentives lead to similar outcomes. When borrowing is easier than reform, borrowing continues. When printing avoids immediate pain, printing becomes policy. Innovation often delays consequences, which makes the eventual adjustment more severe. The longer imbalances are masked, the sharper the correction becomes. This is why late-stage systems appear strongest just before transition. The phrase, "this time is different," has preceded every major monetary reset. It reflects confidence at the peak, not foresight. The mechanisms evolve, the tools change, the players rotate, the structure remains. Once claims exceed productive capacity for long enough, the system must reprice. Belief does not stop that process, it only delays recognition. By the time recognition arrives, adjustment is already underway. Stage 4 is not a sudden disappearance of money or markets. It is a rapid repricing of reality. Demand for the former reserve currency falls unevenly at first, then accelerates as alternatives mature. Purchasing power erodes quietly through higher import costs, rising necessities, and weaker wages. Savings lose strength long before panic appears. As foreign buyers retreat, governments rely increasingly on domestic financing. Central banks expand balance sheets to stabilize markets. Inflation becomes persistent rather than temporary. Interest rates rise, not because growth is strong, but because trust must be purchased. Credit tightens, investment slows, housing and equities revalue against higher borrowing costs. The currency does not vanish, it becomes ordinary. That loss of privilege is the shock. Being one option among many removes the subsidy reserve status provided for decades. Living standards adjust downward to match real productivity. Social tension rises as promises collide with constraints. Fiscal choices become painful. Programs shrink, taxes rise. Neither restores confidence. The adjustment continues until a new equilibrium forms. History shows stage 4 rewards preparation, not prediction. Those holding depreciating claims suffer most. Those positioned in productive assets, resilient income, and flexibility preserve purchasing power. The transition is not instant, it is decisive. Stage 4 also reshapes incentives for individuals and institutions. Dependence becomes vulnerability. Systems built around a single currency, market, or employer face concentrated risk. Diversification shifts from theory to necessity. Income stability matters more than nominal returns. Assets reprice according to utility rather than narrative. Hard assets, infrastructure, energy, and productive land retain relevance because they serve needs regardless of monetary unit. Financial instruments tied to perpetual liquidity underperform as conditions tighten. Cash loses safety when issuance accelerates. Labor markets change. Skills that cross borders, platforms, and currencies gain value. Digital services, exportable expertise, and ownership of distribution outperform localized roles. Mobility, legal structure, and optionality matter more than scale. Governments prioritize stability over growth. Regulation increases. Capital controls become tempting. These measures slow exits but do not reverse trends. Private actors adapt faster than policy. Understanding this stage is not about fear. It is about alignment. When incentives change, outcomes follow. Those who recognize the shift early can redesign exposure deliberately rather than react under pressure. Stage 4 does not eliminate opportunity, it redistributes it alone. This analysis is not a prediction or a call to panic. It is a framework for understanding where incentives are moving before headlines force awareness. Most people encounter currency transitions only after purchasing power has already been lost. By then, choices are limited and reactions are expensive. You now have the pattern. You understand why reserve systems do not end suddenly, why confidence erodes before prices move, and why preparation matters more than timing. This perspective allows deliberate positioning instead of emotional response. In the next breakdown, we will examine what historically preserved value during previous transitions, what appeared safe but failed, and how individuals adapted successfully. We will discuss assets, structures, and strategies that functioned across regimes rather than within a single system. If this framework changed how you view money, risk, or stability, stay connected. Subscribe and enable notifications so you see the next release when it goes live. The information is most useful before urgency sets in. History does not reward awareness after the fact. It rewards those who act while options remain available. The transition is underway. Understanding it early is not advantage, it is protection. Prepare now, think clearly, and choose resilience over complacency, always.